In the final weeks of 2025, the global financial system does not collapse. There are no sirens, no emergency broadcasts, no single dramatic headline announcing disaster. Instead, something quieter happens. Across different markets, in different countries, warning signals begin to flash at the same time. Signals that rarely align. Each one, on its own, looks manageable. Together, they tell a very different story. In the United States, stock market valuations drift into territory previously seen only at the most speculative moments in history. Long-term valuation metrics, designed to smooth out short-term optimism, suggest prices are stretched far beyond what underlying economic growth can support. Corporate profits remain positive, but their future path increasingly depends on financial conditions that no longer exist. At the same time, commercial real estate districts across major cities sit unusually still. Office towers that once symbolized economic dominance operate half-empty. Their market values have fallen sharply from pandemic-era peaks. Yet many of these losses remain invisible, absorbed quietly within balance sheets, postponed rather than recognized. Meanwhile, in the global credit market, a massive refinancing cycle approaches. Trillions of dollars in corporate debt, issued during years of near-zero interest rates, must soon be rolled over into a world where borrowing costs are dramatically higher. What once felt sustainable begins to look fragile. None of these developments are new on their own. Markets have always faced valuation cycles. Real estate has always risen and fallen. Debt has always needed refinancing. But history suggests something unusual happens when these pressures emerge simultaneously. This is where the story changes. Modern financial systems are deeply interconnected. Corporate earnings depend on consumer spending. Consumer spending depends on employment and asset values. Asset values depend on liquidity, credit availability, and confidence. When stress moves through one channel, it rarely stays contained. In earlier crises, damage was often concentrated. One asset class collapsed while another provided stability. Investors rotated. Central banks intervened. Capital found shelter. But by the mid-2020s, many of those traditional shelters appear unusually exposed. Years of ultra-low interest rates and large-scale monetary intervention inflated not one market, but nearly all of them: stocks, bonds, real estate, private capital, and speculative digital assets rose together, supported by abundant liquidity rather than underlying productivity growth. This created what some analysts quietly refer to as an everything expansion, a period where asset prices across the spectrum rose faster than the real economy that supports them. When every major asset class becomes dependent on the same conditions, diversification weakens, correlations rise, protection disappears. By late 2025, those shared conditions begin to shift. Interest rates, while no longer rising rapidly, remain far above the levels that fueled the previous decade's growth. Corporate financing costs adjust upward. Margins compress. Earnings forecasts soften. Markets that once priced perfection begin to reassess risk. Small declines follow. At first, these moves feel ordinary. A pullback, a reset. Analysts reassure viewers that markets have weathered worse. But beneath the surface, leverage matters. Large portions of modern investing are no longer discretionary. Passive funds, volatility-based strategies, and algorithmic systems respond mechanically to price movements. When markets fall beyond certain thresholds, selling accelerates automatically, regardless of long-term value. This changes the character of downturns. Losses that once unfolded slowly now propagate at digital speed. Capital flows reverse. Liquidity thins. What starts as a valuation adjustment becomes a structural stress. As equity markets weaken, household wealth contracts, consumption softens, revenue growth slows. Corporate balance sheets, already stretched by years of cheap borrowing, faced rising refinancing risk. Debt that looked manageable at low interest rates becomes far less so when rolled over. Defaults do not surge immediately. They rarely do, but credit spreads widen. Investors demand compensation for risk. Funding costs climb further. This pressure does not remain confined to public markets. Banks, pension funds, and insurers hold a complex mix of assets, equities, corporate bonds, real estate exposure. Declines across multiple categories simultaneously strain capital buffers. Institutions respond by reducing risk. Lending standards tighten. Credit availability contracts. Economic activity slows. As it does, commercial real estate faces a delayed reckoning. Properties financed under optimistic assumptions struggle to refinance. Valuations adjust downward. Losses that were once theoretical become realized. History shows that financial stress rarely announces itself loudly at first. It builds through feedback loops. Asset prices influence behavior. Behavior influences earnings. Earnings influence creditworthiness. Creditworthiness influences asset prices. By early 2026, these loops begin to reinforce one another. The concern is not that a single market is overheated. It is that multiple systems, equities, credit, property, sovereign finance have all grown dependent on conditions that cannot return easily. This is why some observers describe the moment not as a traditional bubble, but as a systemic imbalance. In past crises, central banks cut rates aggressively. Governments borrowed heavily. These actions stabilized markets because starting debt levels were lower and policy credibility was intact. By contrast, entering the second half of the 2020s, global debt burdens are historically elevated. Public balance sheets are already stretched. Central bank balance sheets remain large. Political consensus around emergency intervention is weaker. This does not mean intervention is impossible. It means it is less powerful, slower, and more costly. As confidence erodes, markets begin to price not just economic slowdown, but policy constraint. This shift in expectations matters. When investors believe authorities can always backstop losses, risk premiums stay low. When that belief weakens, markets reprice quickly. The result is not a single dramatic crash, but a broad, grinding repricing across asset classes, each feeding pressure into the next. By mid-2026, the question facing the global economy is no longer whether growth slows. It is whether the system can absorb simultaneous adjustments across markets that have rarely declined together, and that question remains unanswered. Because what follows is not driven by panic alone, but by arithmetic debt service costs, income flows, refinancing schedules, and liquidity mechanics. The story of the next phase is not about fear. It is about structure. And in the next part, we examine how modern financial architecture, passive investing, leverage, global capital flows, and political constraints transforms stress into something far larger than a typical downturn. The structure of modern markets matters more than the headlines that describe them. Over the past 2 decades, the way capital moves through the global financial system has changed fundamentally. Decisions once made by individual investors, portfolio managers, and credit committees are now increasingly executed by rules-based systems. Index funds, risk parity strategies, volatility targeting, and automated hedging dominate daily flows. These systems do not pause to assess long-term value. They respond to price, volatility, and liquidity signals. When markets are calm, they reinforce stability. When markets destabilize, they amplify movement. This is not a flaw. It is a design choice, one that prioritizes efficiency during expansion, but sacrifices resilience during contraction. By the mid-2020s, passive investment vehicles hold a historically unprecedented share of global equities. Capital that once rotated gradually now moves in unison. When prices decline past predefined thresholds, selling accelerates automatically. Liquidity disappears precisely when it is needed most. This dynamic did not exist in 1929. It barely existed in 2008. Today, it is central. At the same time, leverage is no longer confined to traditional margin accounts. It is embedded throughout the system, in derivatives, structured credit products, private funds, and corporate balance sheets. Much of it remains hidden until volatility forces disclosure. As asset prices soften, leverage becomes visible. The first stress often appears in equities. Earnings expectations adjust downward. Valuations compress. Losses accumulate. Investors who borrowed against portfolios receive margin calls. Forced selling begins. These sales are not expressions of opinion. They are mechanical responses to collateral thresholds. As prices fall further, volatility rises. Rising volatility triggers additional risk reduction from funds designed to maintain stable risk exposure. This creates a feedback loop. Selling begets volatility. Volatility begets more selling. The consequences ripple outward. Corporate bond markets begin to feel pressure next. Credit spreads widen. Refinancing becomes more expensive. Companies with strong balance sheets survive. Those with heavy debt loads face difficult choices. In earlier cycles, companies relied on banks as lenders of last resort. By the 2020s, much of corporate lending has migrated to non-bank institutions, private credit funds, insurance-linked vehicles, and securitized loan structures. These lenders are less regulated, less transparent, and less equipped to absorb systemic losses. When defaults rise, losses surface unevenly and with delay. Valuations are marked infrequently. Investors discover damage months after it occurs. By then, confidence has already eroded. Banks, though more regulated than before 2008, remain exposed through indirect channels. They hold corporate bonds. They provide credit lines. They finance commercial property. Commercial real estate becomes a focal point, not because it collapses first, but because it collapses slowly. Office buildings financed during years of optimism struggle to refinance in a higher rate environment. Occupancy remains structurally lower than before. Appraisals lag reality. Losses accumulate quietly. As these losses eventually surface, they strain bank capital. Lending standards tighten. Credit availability contracts further. The contraction moves from markets into the real economy. Businesses reduce investment. Hiring slows. Layoffs rise. Consumer confidence weakens. Spending declines. This transition from financial stress to economic slowdown is where geopolitical constraints become relevant. In previous crises, global coordination softened the blow. Central banks acted together. Governments expanded fiscal support. Trade flows continued relatively smoothly. By contrast, the mid-2020s are defined by fragmentation. Geopolitical rivalry complicates coordination. Strategic competition reshapes supply chains. Sanctions, trade barriers, and industrial policy reduce efficiency. Inflation remains sensitive to disruptions. This limits the effectiveness of traditional crisis responses. Central banks face a dilemma. Cutting rates aggressively risks reigniting inflation. Expanding balance sheets risks currency instability. Doing too little risks deeper recession. Fiscal authorities face parallel constraints. Debt levels are already high. Political polarization slows response. Markets scrutinize deficit spending more critically than in the past. As a result, policy actions arrive later and with less force. This delay matters. Financial systems are forward-looking. When participants sense hesitation, risk premiums rise. Borrowing costs increase. Asset prices adjust downward to reflect uncertainty. This is not panic, it is repricing. As conditions tighten, capital flows reverse globally. Emerging markets face pressure. Currencies weaken. External debt becomes harder to service. Contagion spreads faster than in previous decades due to digital markets and real-time settlement. What once unfolded over months now unfolds in weeks. As stress accumulates across equities, credit, real estate, and sovereign finance, diversification loses effectiveness. Assets that historically moved independently begin to decline together. This is the defining characteristic of a systemic event. By mid-2026, the issue is no longer whether markets recover quickly. It is whether the adjustment can occur without triggering cascading institutional failures. This is where confidence becomes critical. Confidence in banks. Confidence in governments. Confidence in currencies. When confidence weakens across multiple domains simultaneously, stabilizing forces struggle to gain traction. Yet, even in this environment, outcomes are not uniform. Some actors are insulated. Some institutions adapt. Some sectors continue operating with relative stability. Crises redistribute power as much as they destroy value. Understanding who absorbs losses and who emerges stronger requires examining how wealth, leverage, and exposure are distributed. That examination comes next, because the final phase of this story is not just about collapse, but about consequence. Who bears the cost, how societies respond, and what kind of system emerges afterward. When large financial systems reset, the effects are not distributed evenly. Some losses are immediate and visible. Others unfold quietly over years, reshaping institutions, careers, and national priorities. The final phase of a systemic adjustment is rarely defined by the moment markets bottom. It is defined by who is forced to change behavior afterward. As asset prices reprice and credit tightens, households experience the shift first through employment and purchasing power. Job losses do not arrive all at once. They spread sector by sector, beginning in finance, construction, and discretionary industries, then extending outward. For many households, the damage is not theoretical. Retirement balances decline. Home equity contracts, the psychological effect of simultaneous losses across multiple assets, alters spending habits more deeply than a single market downturn ever could. This matters because modern economies are consumption-driven. When confidence weakens broadly, recovery slows even after markets stabilize. Institutions face parallel challenges. Pension funds, insurance companies, and sovereign wealth vehicles operate under assumptions about long-term returns and correlations. When multiple asset classes underperform together, those assumptions fail. Adjustments follow: reduced benefits, increased contributions, altered risk tolerance. None of this happens dramatically. It happens through revisions, amendments, and policy changes that appear technical, but shape outcomes for decades. Governments respond unevenly. Some prioritize stabilization, others prioritize currency defense. Some expand fiscal support, others retreat under political pressure. The result is a more fragmented global response than in past crises. This fragmentation accelerates a trend already underway: the gradual shift away from a singular global financial center toward a more multipolar system. Capital becomes more selective. Supply chains become more regional. Strategic assets receive protection. Financial globalization slows. In this environment, volatility remains elevated even after markets recover. Recovery itself does not look like previous cycles. Rather than a rapid rebound driven by stimulus and optimism, the post-adjustment phase is defined by slower growth, higher risk premiums, and greater emphasis on balance sheet strength. Returns come from productivity, not multiple expansion. Some sectors adapt well. Essential services continue operating. Infrastructure investment expands selectively. Industries with pricing power and low leverage gain relative strength. Businesses that relied on financial engineering lose influence. This shift reshapes corporate leadership. Companies that survived not because they were largest, but because they were most resilient, gain market share. Consolidation follows. Power concentrates differently than before. At the individual level, outcomes diverge sharply. Those with diversified income streams, minimal leverage, and long-time horizons recover more fully. Those dependent on asset appreciation or credit access face longer adjustment periods. This divergence influences politics. Economic stress alters voter priorities. Fiscal debates intensify. Policy becomes more reactive. Governments face pressure to protect domestic industries and employment. Internationally, trust erodes. Countries reassess financial exposure. Reserve management changes. Currency diversification increases gradually, not abruptly, but persistently. The global financial order evolves through accumulation, not revolution. Importantly, this process does not end in collapse. Systems do not disappear, they recalibrate. Markets eventually stabilize at lower valuation baselines. Credit becomes more expensive, but more disciplined. Asset prices reflect cash flows more than liquidity conditions. History suggests that periods of excess are followed by periods of restraint. The significance of the mid-2020s adjustment lies not in its drama, but in its breadth. When multiple asset classes reprice together, societies confront the limits of financial expansion. The lesson is structural, not moral. Extended periods of low-cost capital reshape behavior. When those conditions reverse, the adjustment reflects accumulated dependency rather than sudden error. This is why such periods are remembered not as single events, but as turning points. They mark the end of one regime and the slow formation of another. Years later, historians rarely describe these moments using the language of panic. They describe them as transitions from liquidity-driven growth to balance sheet-driven stability, from expansion to consolidation, from assumption to constraint. By the late 2020s, the global economy does not look like it did before. Growth resumes, but more unevenly. Risk is priced differently. Financial optimism is tempered by memory. And while losses fade from headlines, their influence persists in policy, in institutions, and in how societies understand risk. Because when every major asset class rises together, the correction is not just financial, it is structural. And structure, once changed, rarely returns to its previous form.